Why the Japanese yen is falling. Japan is the third largest economy in the world and has one of the most influential currencies in global trade. But the Japanese yen has been in free fall, losing more than 40% of its value. This once relatively stable currency faces a crisis in the near future. But why is this? Why is Japan on the verge of a currency crisis? And what does this mean for the rest of the world? Hi, and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. In this video, we'll look into the causes of the collapse of the Japanese yen and its implications for the future of the third largest economy in the world. But before we begin, make sure to like this video, subscribe, and click on the notification bell to stay updated with our videos. That said, let's start. The US dollar's appreciation has been one of the major unforeseen repercussions of the Federal Reserve's rate hike cycle this year. Treasury bonds and all other assets denominated in the US dollar became much more alluring to international investors with the US interest rate increase. Thus, foreigners began swapping their local currencies for US dollars to benefit from the high returns. As a result, there is an increased demand which raises the US dollar's value. And because of this, the consequences of the Federal Reserve's actions affect economies worldwide. Japan, which might soon have a currency crisis, has been one of the major countries affected the most. The Japanese yen has lost more than 40% of its value since the start of 2021, from roughly 100 yen per dollar to 145 yen today. And since the mid-1980s, this has been the currency's weakest point. The situation became so critical that in September, the nation's central bank made an emergency intervention of $20 billion worth of its own currency on the open market. This is the biggest currency intervention they have carried out in over 20 years. For the past 20 years, consumer price index has remained below the central bank's target of 2%, but it has recently risen. In addition, inflation reached 3% in August. Meanwhile, the inflation rates in the US and Europe are both about 10%, so this is mild by comparison. However, since 1991, the island nation has not had a higher rate. Japan's economy saw tremendous growth in the 1970s and 1980s as the country re-industrialized in the wake of World War II. They introduced factory automation and continue to be the leaders in such industry. Both the stock market and the economy were thriving, and by the turn of the millennium, most economists predicted that Japan would surpass the US as the largest economy in the world. Japanese institutions and ordinary people began investing their newly acquired riches in the stock and real estate markets, which resulted in a massive asset price bubble. In 1980, compared to all of California's real estate, the Imperial Palace and its surrounding area in Tokyo were worth far more in value. The Imperial Palace, of course, was never up for sale. To arrive at this figure, the cost per square meter of the most expensive properties in the central business district and relatively small real estate transactions was extrapolated. Nevertheless, the stock and real estate markets had skyrocketed in value. The bubble ultimately burst in 1989 when real estate values dropped by more than 80% and a devastating recession ensued. Simultaneously, birth rates have been declining for various socioeconomic and cultural factors. An aging population and a drop in the number of working-age people have resulted from a lack of new births and rising life expectancy. Because of this, economic stagnation has resulted from unfavorable demographic trends. In an effort to stimulate growth, the Bank of Japan has implemented a monetary policy regime that is arguably the most extreme in human history. Multiple quantitative easing initiatives amounting to roughly 600 trillion yen or $4 trillion have been put into place since 2010, which is equivalent to almost 80% of their GDP. In 2016, they even went to the point of adopting negative interest rates. Commercial banks would be required to pay an annual charge of 0.01% for any excess reserves they keep on hold with the central bank. It was expected that by doing this, Main Street banks would begin lending money to the private sector. Additionally, they started printing cash to purchase stocks on the Tokyo Stock Exchange. By 2018, they accounted for 40% of publicly traded businesses and became one of the top 10 shareholders. This was intended to raise share prices in order to persuade companies to expand business investment. It was a last-ditch effort to promote economic growth. However, the economy remained stagnant despite printing trillions of dollars, and the inflation rate stayed below the targeted 2% level. In fact, it even briefly dropped below zero in 2016. How is this even possible? The central bank printing money is one thing. Another thing would be for this to wind up in the hands of ordinary people who could spend it. Keep in mind that Japan's population is declining. Since its 2008 peak, it has decreased by roughly 2 million. But for a country with over 120 million people, this isn't extreme. However, the rising life expectancy hides the catastrophic nature of the demographic situation. Over the last several decades, people living longer have mitigated the impact of reduced birth rates. Since its peak, the working-age population has dropped by 12 million, or over 15%, and it has had some strange economic repercussions. When interest rates drop, it becomes simpler for consumers to borrow money to, say, buy a new home. This will raise property values and promote new construction, positively impacting the economy. When a corporation's stock price increases and bond interest rates drop, it also becomes easier to raise money to create more factories or expand its commercial activities. The issue is that despite extremely low interest rates, relatively few capital-intensive projects are financially feasible due to the declining population. Japan has about 7.5 million unoccupied properties, or around 13% of the country's total housing stock. Simply put, there are not enough people to occupy the homes. In rural areas, fully functional houses may be purchased for as low as 500 yen. In fact, several small towns provide free houses and launch nationwide marketing efforts to entice residents to relocate there. Of course, real estate is still expensive in major cities like Tokyo and Kobe. However, as these cities are already fully developed, there is little to no need for further construction. Similarly, if a company wanted to establish a new factory, they would not be able to recruit any new employees since the number of people who are of working age is fast declining. It makes no sense to expand, regardless of how much your shares are worth or how cheaply you can borrow more money. Even if the central bank prints trillions of yen, they all simply land up in vaults and have no impact on inflation or economic development. Although inflation has been persistently low for years, it eventually rose to 3% in August of this year. Since 2014, this has been the quickest rate of the consumer price increase. The issue is that the wrong factors are causing inflation to rise. Japan's heavy reliance on energy imports from outside is another significant issue, in addition to their economic stagflation. Historically, Japan relied almost entirely on imports to meet their energy demands because there is hardly any extractable natural gas or oil. In an effort to lessen their reliance on imports, they made significant investments in nuclear power plants in the late 20th century. However, they were shut down due to safety concerns following the Fukushima nuclear power disaster in 2011. Eventually, some of them were opened again, but the number was still only around 1/5 of what they had before the catastrophe. Their dependence on gas, which currently accounts for about half of their total energy consumption, has increased due to the unavailability of nuclear energy. 93% of the nation's overall energy needs are imported, with liquefied natural gas making up most of this. This year, liquefied natural gas costs have risen to more than 5 times above average. This is due to both the underinvestment made during the pandemic and the increasing demand from Europe following the Nord Stream pipeline's shutdown. As a result, this has widened Japan's trade imbalance and placed pressure on their currency as they are a significant energy importer. This now brings us to Japan's currency crisis. Over the past 2 years, the Japanese yen has decreased by more than 40%. Currency depreciation is not necessarily detrimental to the economy. The Bank of Japan intervened in foreign exchange markets in the past to influence the yen's value downwards. Additionally, currency depreciation has 2 main effects. First, consumer demand declines when products imported from outside become more expensive. Second, the cost of domestically produced items to overseas consumers drops significantly, increasing exports. The second effect often predominates in Japan's export-driven economy, hence, the government usually wants the currency to be weaker to strengthen the export industry. For instance, in 2013, when the currency dramatically increased, it resulted in a massive trade imbalance. But they had a significant trade surplus in 2016 when the currency declined. But in 2022, this pattern was reversed. The trade imbalance is on track to reach a record high of around $150 billion despite a massive yen depreciation. The rising cost of energy imports is mostly to blame for this. The increasing cost of imported energy is forcing Japanese businesses and people to change more and more of their money into US dollars, pushing the yen's value down. The industrial sector's competitiveness is also being harmed by the high energy cost and other imported raw materials. This offsets the advantage of depreciation for them. The Federal Reserve raising interest rates is another aspect that affects the currency. Because inflation is currently low, the Bank of Japan has not raised interest rates. As a result, the increasing interest rate differential renders American bonds and other financial assets more appealing than their Japanese counterparts, which causes net currency outflows. In an effort to stop the yen's depreciation, the Bank of Japan spent $20 billion of its US dollar reserves in September to purchase yen on the open market. This is their largest intervention in more than 20 years. However, it is a little more than a rounding error in contrast to the size of the economy and did very little to stop the yen's drop. The Bank of Japan has $1.3 trillion in US dollar reserves, allowing them to theoretically spend more than $20 billion to strengthen their currency. However, the issue is that most of their reserves are kept in US Treasury bonds. If they start selling off their Treasury bill holdings in larger amounts, US bond rates will greatly increase. As a result, their interest rate differential would increase. This would negate many, if not all, of the yen's benefits. Thus, raising interest rates would be the only option to strengthen the currency. However, this is the last thing the central bank would be ready to do given the economy's continued stagnation and low inflation rate. Given Japan's reliance on energy imports, one would wonder why their inflation rate has stayed so low in contrast to other developed economies. In August of this year, consumer prices rose by 3% compared to 8.3% in the US, 9.1% in the EU, and 9.9% in the UK. People are not accustomed to price increases since inflation has been so low for such a long time in the country. Consumers would experience sticker shock and put off buying non-essential goods if businesses did raise prices significantly. Moreover, data from the investment bank ING shows that producer prices rose by more than 10% in 2022. In relation to this, Japanese businesses are absorbing higher input prices without passing them along to consumers, even though consumer prices have only increased by 3%. Unfortunately, this won't last in the long run. If producer prices keep increasing, businesses will eventually be compelled to raise prices or risk going out of business. Second, because the vast majority of the nation's natural gas imports are covered by multi-year, fixed-price contracts, prices have not yet significantly risen. These contracts will eventually run their course and prices will be reset at substantially higher rates. Currently, the Consumer Price Index for Japan only accounts for around 10% of energy costs, but this may potentially double after the contracts expire. So even if the current inflation situation is very benign, we can anticipate it to grow significantly worse over the next few years. Additionally, keep in mind that the aging population has contributed to a deflationary trend by lowering the cost of housing and other unused infrastructure. However, this benefit to inflation won't stick around for long. The proportion of people in the working age group to the total population peaked in the middle of the 1990s, but it has declined precipitously from 69% to 58%, and this trend will continue in the future. By definition, retired individuals don't produce anything. Consequently, the total output will decline as the population of working age declines. Because retirees continue to consume commodities long after they cease producing, this will become inflationary. The Japanese central bank has aimed to raise inflation over the past 3 decades to boost economic growth. However, they won't see any economic expansion as they will instead experience inflation. It sounds like we've reached the end of this video. If you found this video insightful, please hit like and subscribe, and comment down below with your thoughts about Japan and its currency. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you next time!